Chapter 8, Federal Securities Acts. We begin with the 1933 Securities Act, which governs the issuance of IPOs. The 33 Act gives investors adequate information for investment decisions and assurance that financial statements and disclosures can be relied upon. It also gives investors recourse against accountants. Now, who can sue under the 33 Act? Purchasers of securities only. Now, in order for the accountant to be liable under the 33 Act, these are the requirements. First, there were damages, and second, there were material misstatements. Damages and material misstatements. Note that reliance on the financial statements is not a requirement under the 33 Act unless they were purchased more than a year after the security was registered. Under the 33 Act, a purchaser does not need to even prove negligence, only damages and material misstatements. Now, if the poor accountant is sued, there are some defenses that they can use. And here they are. They used due diligence. They followed GAAP. Yes, there were damages, but they were not caused by the accountant. Or the plaintiff knew of the material misstatements and decided to purchase the securities anyway. Under the 33 Act, registration statements must be filed with and accepted by the SEC. And these registration statements include audited financial statements and a prospectus. Now, there are some entities that are exempt from filing registration statements, and they are banks, commercial paper with less than 9 months until maturity, farmers, co-ops, securities sold by charities, securities sold by governments, and securities sold in one state. A few caveats, however: the issuer must be a resident of that state, with 80% of the company business done in the state, and investors must be residents as well. Securities under the 33 Act also include stocks, stock options, stock warrants, and limited partnership interests. Note, general partnership interests are not allowed to be registered securities under the 33 Act. Also, bonds. Now, there are some registration form options, and they include S1, which is the long form, or S2 and S3, which are less detailed and usually preferred by issuers. Regulation A. Under Regulation A, the old rules said that an issuer can issue $5 million of securities per year and be exempt from the 33 rules if they file a notice with the SEC, but the Jobs Act bumped that from $5 million to $50 million. We will now turn to Regulation D. Regulation D involves Rules 504 and 506. Now, you may note that Rule 505 is not listed, and that's because it is no longer in effect. Now, what Rule 504 and 506 of Regulation D do is that they make it so that if a company wants to sell some of their securities and not have to jump through all the hoops of registering their securities and the federal securities laws, well, they can do that. It makes it a little bit easier. So under Rule 504, you can sell up to $5 million of securities per year max with unlimited investors, an unlimited number of investors. And Rule 506 says you can sell unlimited amounts of securities, but you can only solicit and advertise to accredited investors. So again, Rule 504, 5 million. Rule 506, unlimited securities. Rule 504, unlimited investors. Rule 506, you can solicit and advertise to accredited investors only. And that is Rules 504 and 506 of Regulation D. Now the 1934 Securities Act. This governs the trading and the selling of securities after the IPO. Under the 34 Act, a registrant must file an audited 10-K, also a 10-Q quarterly report, which must be reviewed but not audited, and also a Form 8K, which is a notice of a material event and must be filed within 4 days of that event. Now, who can sue under the 34 Act? Purchasers and sellers. Sellers get tossed in there too. Purchasers and sellers of securities. Contrast that with the 33 Act, which only allows purchasers of securities. The 34 Act includes purchasers and sellers. Now, these are the requirements for the poor old accountant to be liable for fraud. Damages and material misstatements, which is the same as the 33 Act. The 34 Act adds on an extra requirement, reliance on those financial statements. Finally, scienter or reckless disregard for the truth is also required to sue under the 34 Act. So what did we just add in there? Reliance on those financial statements and scienter, a reckless disregard for the truth. Now, under the 34 Act, the accountant must have procedures in place to determine if going concern is an issue. Also, they must determine if any material related party transactions have occurred and determine if any material illegal acts occurred. Insider trading rules. These apply to officers, directors, and 10% owners. Now, you will also see accounting staff in charge of sensitive information flagged as insiders as well. The final topic in this chapter is proxy solicitation requirements. The proxy must give shareholders audited balance sheets from the 2 most recent years. This requirement holds true even if only one class of stock exists. This concludes Chapter 8.